Welcome back to another hashtag Finance Friday. And hopefully you tuned in during our session last week where we were talking to a fellow attorney, not that I'm an attorney, but a fellow entrepreneur who's also an attorney, Veronique Verlander. And we were talking all about the difference between registering your business as a sole proprietor and a company. And the conclusion for the most part was that it's probably most beneficial to register as a company, right? Just because there are all sorts of benefits that come along with being incorporated. But we need to consider all of the aspects that go along with being registered as a company. So one of those factors that we need to think about is tax. And I'm sure that you don't like paying tax and you don't like it when you have to submit your tax return and it's a pain, right? And ultimately, at the end of the day, often we actually don't want to be paying as much tax at all. So when you think about registering as a company, there are special benefits that come along with that. One of which is that you get taxed at only 28%, as opposed to in your personal capacity, where you might be taxed at up to 42% or 43%, depending on what tax bracket you're in. And now, especially for a small business, SARS has decided that they want to really encourage us to register and to help promote the growth of small businesses. So they have this special benefit that is allowed, and it is called, wait for it, drum roll, Small Business Corporations Tax. It's a long name, and we shorten it to SBC Tax. So that is really what I want to talk about today. So let's have a look at some of the benefits and see if we can get you excited about this concept of registering as a business under the SBC tax rules. So firstly, if you have taxable income, which means the income that you will get taxed on at the end of the year, under 80,000 Rand for the year, you pay no tax. Right? Cool. Then once you become earning between 80,000 and 365,000, you end up paying tax at around 7%, which is still a significant saving from 28%, right? Yes, it's a little bit of tax, but it's only 7%. I mean, where are you going to get that? Then once you start earning a little bit more, from 365,000 to 550,000, they start hiking up that tax rate and you get taxed at around 21%, which is still better than 28%. But after 550,000 for the year, you end up being pushed into the 28% tax bracket in any case. But it's only for that portion that is over 550,000. It's not for the full amount, which is what you would be taxed on if you were just a normal company. And over and above these tax breaks that you get, in terms of what rate you get taxed at, you also get special allowances on your assets that you purchase. Now, if you are in the manufacturing industry, you are making anything, there's a process around it, you can claim the full amount of the assets you acquire in the year that you purchase it, okay? And if it's an asset, but you're not in the manufacturing industry or it's not for manufacturing purposes, then you get to claim it over a 3-year process, a 3-year period, between 50% in the first year, 30% in the second year, and the remaining 20% in the third year. Now, this is a significant incentive because if you were not an SBC, you would end up paying that off over a period of time, and you might be able to claim it in terms of Section 11E, which stipulates, for example, a computer can be written off over a period of 4 years, as opposed to 3 years or potentially in 1 year altogether, right? So that is going to help you a lot with your cash flow. So let's think about what you need to do to be able to qualify for these special rules, because they are really great and they can be really helpful. But there are some catches that you need to bear in mind. So firstly, you must be incorporated as a company, as a CC, or a similar entity. That's the first case. Secondly, all shareholders within this small business must be a natural person. In other words, it needs to be a person like you and me. It cannot be a trust. It cannot be another company that has a shareholding in this SBC. Otherwise, you end up being in a situation where you can disregard the tax incentive for the entire business. Okay, and then the third point is your gross income needs to be less than 20 million for the year. Now, the gross income is basically all of the revenue that you generate, all of the income that you have needs to be less than 20 million. Now, if you look back to what we had just now, we're looking at taxable income of around 550,000, right? So you have quite a big differential there between 20 million in terms of your revenue and 550,000 in terms of your profit. Okay, so that's just as an aside. But here are the two kickers that you need to think about. And this is sometimes where, especially service-based industries, fall short. The fourth factor here is that shareholders may not hold shares in any other companies, with a few exceptions like having shares in a listed entity, or maybe some body corporates, or things that are generally part of an investment portfolio. In other words, what they are looking for is specifically at whether or not you have relatively significant influence over another entity or another company, and that you're trying to move around your tax burden, right? They're trying to avoid situations like that. Okay, and then fifthly, the fifth factor is that you may not earn more than 20% of your revenue from investment income or income earned by rendering a personal service. Now, firstly, investment income includes things like dividends, income. It even includes rental income. So if you have investment property within your business, you will not qualify, okay, because there you're generating a large amount of your revenue coming through from rental income. And then the second part there about personal services. Now, personal services includes different services from different fields, specifically you're looking at things like accounting and legal services and a few others. But mostly it's if the service is personally being provided by someone that is connected to this business or is related to this business. So if you are the sole shareholder and you are the one rendering all of these services and you fall within one of these areas that they specifically consider, then you might be sitting in this space of rendering a personal service. But you can avoid these limitations. So in terms of personal service provision, you can avoid it by making sure that you have employed 3 full-time employees in your business, and they should not be connected to the small business at all. Okay, so there are ways to get around it, okay? But if you can avoid some of these issues, especially number 4 and 5, then this could be a really good area, a really good option for you to consider. But I have one final caveat for you. If you are busy building up your taxable income and you're heading towards the higher end of those brackets that I mentioned previously, this is not always going to be a good fit for you. And that's because SARS has really tried hard to make sure that they have closed the loop between having a company or a trust versus being taxed in your personal capacity. So you can get money out of a company in 2 ways, and I'm sure that you know this. But firstly, you can draw a salary out of the business, which means that it reduces the taxable income or it reduces the profit in the business, but that salary is going into your hands and you're going to be taxed on that salary in your personal capacity at a potentially a slightly higher marginal tax rate, right? That's the first option. The second option is that you can draw a dividend out of the business. Now, if you're drawing a dividend out of the business, that dividend is not going to be taxed in your hands. Okay, you will have 15% dividends tax, but it is not going to reduce the taxable income of the business. So you're ending up with a higher profit in your business, but potentially less money in your personal capacity. Okay, so there's this fine line that ends up coming through here where you need to make sure that you're maximizing the tax benefit on both sides in terms of your personal capacity as well as what is happening in the business. So I want to encourage you to look at the full tax consequences of your decisions. And don't ever incorporate as a small business just for the tax benefit, okay? There are other things that you need to consider around this. Things like the cost of legal compliance, making sure that you've got your annual financial statements ready, making sure that you are submitting your annual returns, making sure that all of the things that go around managing a company is being done well. All of those things cost money, okay? So I highly recommend that you get in touch with a tax practitioner if you are considering going down this route to check, like, at what point do you need to be putting money in as or withdrawing money as a salary versus withdrawing money as a dividend? And at which point are you going to really get the true benefit from being an SBC versus being a sole proprietor for tax purposes, okay? And taking into account all of the bookkeeping costs that go along with being a company. So if this is something that you would like to explore more, then please pop me an email, and I'll put my email in the comments below. It's info@upvisor.co.za, and I'd be happy to engage with you and talk you through some of the options and the risks and the benefits of each of the different options. Okay, so are we good? Awesome. So I finally wanted to just remind you of our training academy this month, and you've heard lots about it, but we're talking about pricing. We are attaching values to your outputs. So what are you charging to your customers? And you may have missed our live sessions. You might have missed our initial content workshop, and you missed our application session that happened, but it's fine. We've got all of the information loaded on our training and management platform already, so you can still sign up for 350 Rand per month. And that locks in your subscription, which means that you can get access to next month's session, which is all about financial risk management at the same price. And this is really good going. If you only join us in November, the price is going up at 400 Rand. So I don't know, you may as well just lock it in now while you can, right? So make sure that you do that. It's really great value, even if I say so myself. Okay, this has been maybe a slightly longer session than what we would normally be doing, but hopefully it has been helpful. There's really a lot that one can consider in terms of tax, and it can be really complicated. I didn't go into all of those complications today, but let us know if you have any questions in the comments below, and do pop us an email if you would like to engage further. Until next week, stay strong, stay informed, and stay profitable. Bye.